Welcome to Nisab Finance. If you've ever wondered how to invest and still stay mindful of Sharia principles, you're not alone. Islamic finance is no longer a tiny corner of the market. Depending on how it's measured, it has already reached the multi-trillion-dollar range and continues to grow fast. But as the market grows, so does the confusion around what is truly halal. So today, we're counting down 10 halal investment options that can help you build wealth with clarity, confidence, and peace of mind. For each one, we'll keep it simple: what it is, why it may fit a halal framework, and what you need to watch out for. Number 10. Sharia-compliant savings accounts. This is the most familiar starting point for many beginners. Instead of earning interest, some Islamic savings products use profit-sharing or asset-based structures designed to avoid Riba. That makes them useful for emergency funds or short-term cash you want to keep liquid. In the U.S., some providers offer profit-sharing accounts through insured banks, which can add another layer of familiarity. But remember this: savings is not the same as investing, and deposit insurance only protects eligible deposits, not market losses. Always check how returns are generated. Number 9. Gold investing. Gold has long been a store of value, especially in uncertain times. From a Sharia perspective, gold can be permissible when it is traded properly and ownership is clear. The key question is simple: do you actually own allocated gold, or do you only own a paper claim? Many scholars distinguish between physical, clearly allocated gold and derivative-style exposure that may not meet the same standard. Gold can help preserve value, but it does not produce income, so it's usually more about stability than growth. Number 8. Halal stocks. For many Muslims, this is the first real step into long-term investing. Halal stocks are shares in companies screened to avoid clearly forbidden industries and excessive involvement with interest. But halal investing is not just about avoiding alcohol or gambling. It often involves balance sheet screens too, like limiting debt and interest-based income. And there is one detail beginners often miss: purification. If a company earns a small amount of non-permissible income, that portion may need to be given to charity. Also, Sharia status can change over time, so a stock that looks halal today is not a lifetime guarantee. Number 7. Sharia-screened ETFs. If you want broad market exposure without picking individual stocks, this is a popular path. A Sharia-screened ETF tracks an index that filters companies by business activity and financial ratios, then rebalances as companies change. That can make it beginner-friendly and more diversified than buying a few shares on your own. It can also reduce the stress of trying to analyze every company manually. The caution here is that not all screened ETFs use the same methodology, and compliance rules can differ. Always read the fund documents and understand how often the index is reviewed. Number 6. Islamic mutual funds. These funds pool money from many investors and place it into Sharia-compliant assets under professional management. Many Islamic funds focus heavily on equities, while others may include commodities or money market instruments. For beginners who want someone else to do the screening and portfolio construction, this can be a helpful option. The trade-off is cost and control. Fund fees can eat into returns, and some funds may be more conservative than you expect. Also, some funds are aligned with sustainability themes, which is exciting, but the label still needs careful review. Number 5. Sukuk. Sukuk are often described as the Sharia-compliant cousin of bonds, but they are not just bonds with a different name. They are structured around an asset, lease, project, or cash flow arrangement, rather than pure interest on a loan. That makes them attractive for investors seeking income with a more faith-conscious structure. Sukuk can be useful for more stable allocation, especially if you want less volatility than stocks. But structure matters a lot. Not every Sukuk is equal in substance, and the details behind the deal are important. Read carefully before assuming the label tells the whole story. Number 4. Halal real estate. Real estate feels intuitive because it's a real asset, something you can see and understand. You can invest directly through a rental property or indirectly through a pooled vehicle with a property focus. In principle, this can fit a halal framework if the financing avoids interest-based debt and the property itself is not used for clearly prohibited activities. But real estate is not automatically halal just because it is property. Financing structure, tenant mix, maintenance costs, and leverage all matter. It can also be illiquid, meaning you may not be able to sell quickly if you need cash. Number 3. Commodity-backed funds. This is a broader way to access real assets such as commodities, often through funds designed to track them. For Muslims, the appeal is similar to gold: tangible exposure, inflation protection, and less reliance on purely financial assets. But this is also where caution gets serious. Some commodity funds rely on contracts, swaps, or structures that may be less straightforward from a Sharia perspective. So the big question is not just what the fund holds, but how it holds it. If you are considering this option, look for physical backing, transparent ownership, and clear fund documentation. Number 2. Private equity and angel investing. This is the high control, high due diligence option. Instead of buying public shares, you invest directly in a private business or startup that you believe has a halal core activity. The potential upside can be meaningful, and you may feel more comfortable when you know exactly what the company does. But the risk is much higher too. Private investments are often illiquid, concentrated, and harder to research. Governance can be weaker, reporting can be limited, and it may take years before you see any return. Only consider this if you can afford to lock up the money. Number 1. Sharia-compliant crowdfunding and fintech opportunities. This is one of the most modern paths on the list and one of the most promising for Muslim investors who want access to small businesses and real-world projects. Islamic crowdfunding and peer-to-peer style platforms can help finance halal ventures through equity, profit sharing, or asset-based models. That can make them especially useful for supporting entrepreneurs and underserved communities. But this space moves fast, and fast is not always safe. Investor protection, disclosure, and Sharia governance matter a lot here. The opportunity is real, but so is the need for careful review. So here's the bigger takeaway. Halal investing is not about finding a magic product. It's about understanding the structure, checking the screens, and matching each option to your goals, timeline, and risk tolerance. Some choices are better for liquidity, some are better for growth, some are better for stability, and some need a much closer look before you trust the label. Before you invest, verify the latest Sharia screening standards and fund documents, because compliance can change over time. And when needed, consult a qualified scholar and a licensed financial professional for your specific situation. Subscribe to Nisab Finance for more halal investing guides.